And we'll be live with the audience in just about 10 seconds.
Hi there, my name is Candace Chevalier, and I'm here to give you a multifamily market update. Hopefully everyone can see my screen okay, and I think we are going ahead and recording, and then we can also take questions. Happy to answer any questions as we go. I'll try to keep my eye on the chat if there is anything. Otherwise, we'll have a little session at the end as well. And then just to go ahead and advance to the next slide, just so that you are at the session that you want to be in. This session is basically an update on the apartment market. My name is Candace Chevalier, and I am with Lee & Associates, the local multifamily team here. I've been selling apartment buildings in the Seattle market for about 20 years. I've worked at large commercial brokerage firms nationwide. I've worked with different syndication groups, franchises, local boutique firms, and I've even run my own firm for a number of years. So lots of experience with the different types of brokerages out there. I joined Lee & Associates at the beginning of 2020, and it's a national firm. Locally, we have about 45 brokers in all of the commercial real estate food groups, including multifamily, of course, office, retail, industrial, land. And so it's fun having an active local team with lots of different areas of expertise. I focus on apartments. Lee & Associates nationally has about 1,000 brokers, about 65 offices. So. And we have offices here locally in Seattle, in Bellevue, in Tacoma, and our team, which is located up in Queen Anne. And one of the things that we love to focus on, just to give you an idea of what we do, we love to help owners just look at the value of their commercial real estate, of their apartment buildings, and get an idea of what the values are, but also how those properties are helping support their investment strategy, their investment goals. And even better is when we have an opportunity to help them put together a strategy to meet those goals. So I'll talk a little bit more about right now about sort of the economy, what we see happening locally, which are drivers for the apartment market. And then we'll dive into sort of the data for apartment sales a little bit later. But just to give you a little bit of an overview, twice a year, our team puts together an overview of the market, and it really has a combination of economic demand, what's happening with rents, what's happening with sales, and then a little bit of information about where we think the market's going. So feel free to reach out if you'd like to be on that list. We also send updates because there's been a lot of moving parts in the market, especially through the pandemic. So that kind of gets us into this economic demand conversation. You know, we've definitely seen a contraction in employment in 2020, which is not a surprise. Employment shrunk by 5.5%. It's recovering this year. I think by year end, we're expecting that total increase to be about 1.8%. And then the good news is sort of looking at 2022, we're back in the range of where we were in 2019 in 2019. So we're kind of, we had a really huge pendulum swing in terms of unemployment, or in terms of employment, and then in terms of unemployment, the rates have kind of, you know, ballooned up last year. I have our current rates here at 5.3, back down to 4.9 for this year, and then expected to be 3.6 in 2022. So we are on a recovery trajectory, which is great news. We've all kind of been through the ringer over the last year, so it's nice to see some recovery. One of the things that's really unique about this market is, and this is all kind of related to apartment demand, is we have an incredible force of technology and hiring and companies coming here to hire our workforce. And I believe in the last 4 years, there was a recent report well, this one was from the Bureau of Labor Statistics, that in the last 4 years, our region added almost 30,000 jobs, specifically in tech. And that's about 9.7% of our total employment. So it is a major factor, major driver for our market. There was an interesting report just recently, but actually put out by CBRE, and talking about tech talent. And this was put out this summer, but I really thought some of these points would be interesting to bring up today. Seattle is really known as being kind of a brain gain market, and we sort of talking about that here. There's different demand drivers. We're talking about technology, and so in terms of the tech pool, it's grown through the thick of the pandemic, which is surprising to me, to 35%. So even in the middle of the pandemic, we were actually growing our tech workforce, while other industries were contracting. That industry was growing. So Seattle's also second in the country for top markets for tech talent and investment, and tech markets that have gained the most talent. And I think it's important to recognize that we're not just tech. So I'll get back to tech in a minute, but this is just a little bit of information. I mentioned that investment review. This is some of the information that we put together and compiled in the investment review, specifically related to education. And I thought this was interesting. We made the #9 spot for top markets in educational attainment. So that means we have a very educated workforce, and in a lot of the fields that are really popular for hiring right now. So the other piece is our area is very popular with millennials, and that demographic has actually grown by 22% since 2014. So the University of Washington actually just recently ranked University of Washington, or actually was ranked by the US News and World Report as #7 in best global universities. So that is, really setting the stage for that underlying education focus in our market. And I thought this was interesting because some of the, we think about the University of Washington, that area as an apartment, an area, a very strong area for apartment demand. Total number of students, almost 50,000, 47,606, with 8,000 of those, just over 8,000 of those as international students. Number of undergraduate students, 9,000, doctoral students, almost 6,000. And then academic and research staff is another 7,500. So that's not included in the student numbers. So that's a major group of apartment rental candidates. So that's sort of an interesting piece. We'll go on to healthcare and life sciences. So we talk a lot about tech, but again, we have a hub here for education, and then secondly, a hub for healthcare and life sciences. And especially through the pandemic, that's actually pushed a lot of these companies to increase their hiring in our market. So those are some kind of positive silver linings, if you will. We're actually world renowned for global health and life science companies. And South Lake Union is a top 10 market for research and development in the country. And it's not just Seattle. We've got biotech manufacturing hotbeds up in the Bothell and Redmond markets as well. And we are consistently the top recipient of NIH funding, National Institute of Health funding. So some other interesting pieces there. In 2020, Washington State was awarded the 6th most funding of any state. We've got Fred Hutch here. We've got University of Washington Medical Center, Virginia Mason, Swedish Children's, Gates Foundation, Allen Institute, Infection Disease Research Institute. So we've got a lot of companies that are hiring people, and many of those people are renters. So once again, not just tech, but let's talk about tech. So thinking about through the thick of the pandemic, the fact that we had that labor pool growth of 35%. Interestingly, San Francisco was a huge drawing market through the internet age, call it in the 2000s. But what Seattle has been really known for more recently is cloud computing. And that's really seen as kind of the next wave of economic growth in the tech sector. So we're positioned very well for that. We have, established tech giants, obviously Microsoft and Amazon, but also, these other major tech groups that are moving major offices up here to be part of that cloud computing initiative. So we've got presence now with Facebook, Google, Apple, Tableau, and these are all hiring in the area. So this just gives you a map of where these companies are located. And I think what's relevant here is these tech workers and other companies are really driving our rental market. So looking at Seattle right now, we're about the sixth most expensive rental. We have the sixth most expensive rents in North America. Interestingly, 22nd, when we look at, for example, tech wage related to apartment growth. So that ratio between how much people are earning and how much people are paying in rent is 22nd. So we're sixth in terms of pricing, but people have a lot more dollars because they're paid well to pay rent in this market. So this means that the renter's dollar can go further here, and that probably that's an indication of room for rents to grow in our market. So we're looking in the next 5 years, probably at about 13.2% rent growth in the next 5 years. And this is in contrast with San Francisco, where rents are actually predicted to contract by 7.9%. So some of what we saw in the pandemic with people leaving downtown Seattle when everything was closed, we saw that in San Francisco too, but the difference is it's not expected to recover like Seattle is. So that's a little bit just of an economic overview, sort of sets the table for talking about rental supply. And we'll talk about supply and then talk a little bit about, we've talked about the demand drivers. Now we'll talk about the supply. And interestingly enough, it has been a pretty tumultuous slowdown. We've seen, this is really looking at where are new apartment units coming from? And you can see a huge delivery this year, which especially as we were watching that delivery going to be happening from our purchase in 2020 in the middle of the pandemic, seeing the fundamentals of the rental market degrading, and then knowing we had this many more units coming online was pretty scary. But what's interesting is we've had incredible absorption, and to the tune of, in the first 6 months of this year, we actually absorbed what is normally 2 years of supply of new units, which is just amazing. Now, some of the things, some of these projects, unfortunately, there's been a huge slowdown on the delivery of these buildings that may have helped in terms of how the rental market was able to absorb these units, because we've had slowdowns in municipal building permitting, code changes, and construction costs ballooned last year. So those are some of the things that really slowed that anticipated unit supply and allowed for sort of that absorption to happen in a more digestible way. And so at this point, demand is really keeping up with the supply. And that is the most important part of this equation, because during the pandemic, we saw an incredible amount of uncertainty and concessions coming into the market, and rental rates fell and all of that. So this is good news. We are also expecting to see a drop off in supply here. You can see 2022 drops off significantly, half of what we delivered this year. And then 2023, 2024, there's just not a lot in the hopper yet. Now, as we get closer to these dates, more and more projects will be in the pipeline. The trick is it's taking a lot longer for these buildings to be built, and not even just the building, the planning and getting through the different review cycles with the city, whether it's Seattle or even, Bellevue and these other markets. It's taking a lot longer, more and more. And so what we're seeing is, when we're looking at when that pipeline is going to build up again, we've got a big delay coming. And I expect that that 2022, 2023 and 4, those years are going to be big years for rent growth. So that positions us well from that standpoint. So now let's look a little bit at market vacancy. This is kind of a wild graph, but I thought you would enjoy it. And it shows a couple things. It's showing the current vacancies as of September 2021. This is fresh data from Commercial Analytics. And what I think is interesting when we look, I'll talk about the line graph first, because that's showing sort of over time a little bit of that historical, what happened with vacancy through the pandemic. So we start here in 2019 and we're going through, and you can just see the total is that orange line, and you could just see how we had very low vacancy in the summer of 2019. And Seattle tends to be a seasonal market, so we tend to see lower vacancy rates in the summer months, and then it ticks up usually about a percentage point in the winter months. No one wants to move when it's raining sideways. And so, but you can see it was fairly stable, and then it just shot up right around the time of the pandemic. So, so we saw that all over. And the interesting thing about this graph is it's showing you by unit type, which I think is a really interesting element when we, people ask, well, how's the rental market? Well, it really depends on your location. Were you in the middle of the BLM protests in Capitol Hill? Were you next to the University of Washington that was shut down last year? There's a lot of things that go into how is the rental market or what's affecting vacancy. Downtown was shut down, so why live there? And then we saw concessions coming into the market. But what is interesting to me is how remarkable the vacancy rates shot up for the smaller CDU and open 1-bedroom units. But it was fairly measured with those larger 2-bedroom, 2-bath, even 3-bedroom units. And really that's because people were locked in their homes. And once they were able to move around a little bit after the lockdown, they were able to search for an apartment that better met their needs for that work from home component. So we're seeing right here what renters did, their behavior during the pandemic. And so now you can see that the studio units, the 1-bedrooms, it's fairly slight. We have very low vacancy again, which is great. And again, this is with all of those deliveries this year of new units, very low vacancies, but you can see that those 2s and 3s are just a little bit more desirable at this time. So then looking at the different markets, I thought this was an interesting slide to share with you just about what our current vacancy by county. And 3%, I mean, it looks in this graph like King County is much worse, but look at the numbers, 3%, 1.5% in Kitsap. Pierce and Snohomish are right kind of neck and neck at 2.3, 2.4%. So very, very low current vacancy rates. And like I said, this is right now. And then I thought it would be interesting to share with you sort of the 6-month change. And you can see how in all categories, essentially over 12 months, our vacancy rates have come down, which is good. And then even on the 6-month mark, they've come down. And so we look at the market in March and September, and so you can see that things have been returning. And concessions are essentially burned off completely at this point. The other thing that I think we'll expect to see and is still happening is this was all fresh data right as school was going back in session. And so if you think of the families that have had the young children back at home, they were able to finally go back to school. And now we have vaccinations for that younger set. And I think that's really going to allow for renters to decide, as Seattle's opening back up again, maybe the outlying markets are still attractive because they have a little bit larger spaces, but maybe those tech workers are going to start angling back in city. So we're expecting to see kind of that return to norm a little bit more. We certainly, saw huge swings, people going out to the suburbs and moving away from the city, but we are seeing the reverse of that happening as well. So here's some current rental trends. Again, that over time is so interesting just to see. This is absolute rents. So for these, and this is for the Tri-County market, looking at the different unit types. Again, average rent you can see in the orange line. But if you're particularly interested in a unit type, you can kind of see that level of detail here. And you can see, that crossing where we saw just a little bit more growth in those larger units through the pandemic. All right, and rent change. This is another interesting one. So this is as of September as well, and it's looking at 6-month rent change and 12-month rent change. And you can see it's up, and it's up in double digits. And in fact, in the open one, 6 months rent change, it's up 20%. So this is just sort of an interesting perspective on, it's easy to say that things are, challenging from a rental standpoint, but this is some great news for where the market's heading. Okay, so talked a little bit about, economic drivers, demand, supply. Now let's dive into apartment sales. And what this is, and this is basically through June. So this is the first half of the year, and then comparing it with basically January 2019, that first bar, the middle bar, which was 2020. You can see how we had incredible fall off in volume. Some of that volume was at the beginning of the year and also sort of at the end of the year as things started to repair, but certainly in the middle of the summer last year, it was really, really quiet. But we've had some major sales. I have sort of those 2021 numbers there for you. And, we've already hit $1 billion in sales as of the first half of the year. And, we can attest our team has actually sold over 20 buildings this year, and that's a record for our team. And, in terms of what we're seeing now, and certainly in the second half of the year, we're really seeing an acceleration of sales volume as there's more comps in the market. People feel more confident about where volume or where value is. And then on top of it, all of the economic data that I just shared with you are inputs to where people think that they can start to raise rents. And we've also haven't even really talked about the eviction ban and the rent increase moratorium, but that obviously had a huge effect on the ability for people to raise rents and ultimately the income that these properties were actually able to earn. So we are expecting to actually be in line and exceed sort of the sales count, for 2021. And this may actually even be conservative because we were forecasting based on just the first half of the year, and we've seen quite a lot of closings every week already since then. So we're really expecting that volume to continue to increase. And then here we've got price per unit. These are broken down by King, Snohomish, and Pierce. Bellevue, there's been a huge premium placed on the east side, especially through the pandemic, where people were really going kind of that flight to the suburbs. Our focus is Seattle apartments, and so we always talk about the board in the burbs concept. That now we're seeing people coming back to downtown, and especially markets like Ballard and Fremont and Queen Anne, where now you've got the Climate Pledge Arena is open, and there's a reason to live in Lower Queen Anne because you're going to be going into Amazon maybe 1 or 2 days a week, and you want to orient yourself. So there's some really interesting drivers in these different markets. But you can see that the price per unit fell, and then now it's starting to regain a little bit of traction in 2021. But these are sort of our averages for these markets for 2021. And then for price per unit, we're also seeing our average right now is $355 for all of the markets. King County is looking really good at $408. And we're seeing, just basically that return to kind of that strength in the market. I would say we're really on par with where we were in 2019. 2020, obviously, we took a dip in price per square foot, price per unit, cap rates, everything softened, but now it's really recovering. So for price per square foot, we were up 13% for Tri-County, just to give you kind of some reference to other years. Pierce had a really strong recovery, up 21% from 2020 and 31% from 2019. So that gives you an idea of really how we've have adjusted. And then we in King County, we kind of gained the ground that we lost in 2020. So we're just within 1% of our high in 2019. So like I said, we've really kind of come back to where we were. And so Snohomish County has been fairly consistent. It's still up actually 7% over last year. So that's price per square foot. Cap rate. So this is an interesting metric, and I'll get into the data in a second, but I just wanted to talk a little bit about how, people talk about cap rates, but it's probably one of the most easily manipulated metrics for sales. And so it's really, and I say manipulated, it's more just that it's up to interpretation. Generally speaking, a low cap rate represents a lower ratio of the income to the price paid. So better for a seller would be a lower cap rate, and a higher cap rate would have more income relative to the price paid and hence be better for a buyer. So fundamentally, that's sort of the tug between whether you want a higher or low cap rate, depends on who you are. But then, we sort of have kind of the seller cap rate, what the seller is using kind of their actual expenses. Maybe they've got earthquake insurance, maybe they put capital improvements into their repair and maintenance, which is very common, and they're trying to basically, from a tax perspective, front load those capital improvements really as an expense. That's kind of what our job is, to sort of figure out how the building really would run under kind of a vanilla circumstance. So that's what you might consider a seller cap rate. A buyer cap rate tends to be pretty optimistic. They're going to minimize the expenses, maximize the ability to increase rents. And that can be also known as sort of a pro forma cap rate. So if the building was running on all cylinders, what would the cap rate be? What would the rents be? How would we minimize the expenses? And then that would also, pro forma and market cap rate are fairly used fairly synonymously. And then also, you might think of a pro forma or a cap rate or a market cap rate as being a rehab cap rate. If you are going in and rehabbing the property, fixing everything up, and then kind of taking it to the next level, you might see another version of a pro forma or a market cap based on that upgraded property. So just wanted to share that because the conversation about cap rates is common, but it's a very nuanced conversation. So from that standpoint, let me get you to the cap rate averages. And here what we're seeing is an average cap rate of 4.5, which is quite low. If you've been in the industry a long time, I remember when we hit a 5 cap, and it was like, we felt like property would never get more expensive, and yet it has. So again, this is through the first half of the year. And in general, what we've seen, and you can see it in the graph, it's slight, but it's there, we've seen a compression in cap rates. So what's interesting is you would normally think of a cap rate compression as increased demand. And especially in a market where we've had this pandemic, and you would think that with a cap rate, it's essentially an evaluation of risk. So you might apply a more risk in an environment like that and demand a higher cap rate. What's happened, especially because there was that ceiling on the rent increases, is we had a year, through 2020, a year of expense growth without any ability with the rent increase cap to raise rents. So operationally, these buildings have actually suffered, but investors are still realizing that there's fundamental value and buying off on that. So that's just a little conversation about when we see a compression in cap rates, why that might be. And it is much market driven as operationally on the property. So Tri-County, 4.5%. And we're seeing, 4.3% there on Snohomish. Pierce a little higher, and King at 4.3. Going forward, expecting to see, again, that demand maybe shift back towards more urban markets from suburban. So that's something to watch, and also, areas where maybe renters would like to be in an area. They're not going in maybe every day. They're not reporting 5 days a week just in lockstep like they were before, but they're going to be going in a few days a week, and they want to be relatively close. I heard about one executive that bought a farm out in Sequim, and now I think that's a tough drive if you're doing it a few times a week, as an example. So let me go to, this is kind of a full slide, I apologize, but it's also, I'm assuming you're interested in specific markets. And we do this twice a year where we glean everything we can about what sales have happened. We look at volume, the number of sales, price per unit, price per square foot, and cap rate averages, and then take those snapshots by market. And so these are the averages as of the first half of the year. And we've got Seattle, it's kind of a roll up of Seattle and then a breakdown by neighborhood. And then we have the same here for the East Side and South King in gray, and then looking at Snohomish County, the averages, but then also kind of giving you a little bit of a breakdown. So there might be questions on that, but that gives you a little bit of a perspective if you're interested in the market that maybe you have property in. So this is always a hot topic, and what I'd like to do is I'll talk through this. I'm not going to go in a ton of detail, but I do think that these are kind of the high points or the important points that have evolved over the last year. So we had some very positive elections, specifically in Seattle, with the election success of Harrell and Sarah Nelson and Davidson. So that was a pretty clear message that that people want to see the return of kind of Seattle and safety and dealing with homelessness and all of these kind of urban issues that occur, but a more proactive approach to solving those issues. So the other piece that's sort of a big positive element is the state of eviction ban and rent increase ban actually finally ended at the end of October. And that was after almost 2 years. So now, there's some freedom to begin to kind of recoup and raise rents, even looking back to 2020 when you couldn't. And what happened to a lot of investors, and may have happened to some of you, is normally we get our tax assessments in the early part of the year, January, something like that. You get your tax assessment, and then you kind of look at your operations, and you might set your rent increases based on how much of a tax increase you're getting. And the unfortunate part of the timing of the pandemic is a lot of owners were just about to put into place that rent increase, and essentially all of that got rolled back. So while those expenses have grown, the income was not able to grow along with it. Okay, so this is kind of old news. This is from the beginning, but wanted to just mention there were some key bills that were passed in the state legislature in 2021. This is really kind of in the thick of and a little bit before the pandemic was occurring, but regarding eviction reform and also just cause evictions. So I'm not going to go into a ton of detail, but if you're interested in learning more, those are some state bills. And then in King County, there was also a pretty sweeping tenant protections ordinance that passed. And so from that standpoint, it brought the concept of just cause to light, which is essentially having specific reasons why, and only those reasons why you might not renew a lease. And so there are some reasons, some just causes, some of the ones that are outlined why you might not really renew a lease is obviously the failure to pay or vacate, certain lease violations, safety issues, things like that. You're also, if you buy a property that you intend to occupy, you have a 90-day notice period for that. And then with appropriate notice, if you're improving a unit or demolishing the unit. So those are some of the things that are kind of those just cause pieces. There was also a cap on move-in expenses and security deposits, total late fees, limitations on that. Interestingly, there was a 120-day notice of rent increase over if the increase is over 3%. So that was another sort of layer. And I'll layer on Seattle in a minute so you can see how all these ordinances kind of tangle up with each other, which is a little bit challenging. So also brought a right to counsel. And also the most controversial element was sort of this preventing a housing provider from being able to have a social security number to perform a background check. So some of the tenant screening capabilities have been handcuffed with this ordinance. And then some penalties if you're not complying with the ordinance. So that was a pretty sweeping one, and just wanted to share that as well. Some of these are quite new. I mean, we just cause for eviction that passed earlier this year, and so did the school year eviction ban. The ones that recently passed that are you may or may not know about, there's an increase, this is for Seattle, an increased notice period. Now it's 180 days, it's 6 months. So as an example, if you're planning to raise your rents May 1st, you have to put that notice out there December 1st. So that's coming right up, heads up on that. And there's also increased sort of communication requirements. What language, I've just included it here. There's specific language that you need to include when giving a rent increase. And there's actually a couple of different notice requirements, twice, I believe. And then also the method that you deliver that rent increase, whether it's certified mail or handing it to an adult in the unit. So just have a read at this. I will say that even though this information is what we have to include in our leases, I actually checked, and the Seattle website is not updated. It's still saying 60 days for Seattle notice period. So both on the tenant side and on the landlord side, it has not been updated. And I think in the ordinance, they asked for 6 months to be able to update it. So while they're pointing tenants to that location, that's not actually the most current information. So that's just an important subtlety to be aware of. And then we have relocation assistance. This is specific for low-income tenants, that if they are moving because of a rent increase, that they would get 3 months of rent paid for help moving. So that those are I don't have any more bad news for you. Those are the ones that just came out. So there's also, so that just gives you a little bit of an idea of the legislative environment. This is all relating to demand, because we do see some buyers are, these regulations are scaring them. Some sellers, these regulations are scaring them too, and they're deciding to make changes. And whether it's putting professional property management in place and not being directly in communication with the tenants anymore, or selling their buildings altogether. We're seeing that. Now on the buyer side, while we are seeing that objection come up, we're seeing very strong demand for investment property in Seattle. And back to the beginning of the talk, how much Seattle is seen as a growth market nationally. It really is. This is our headwind. This is our issue. But if people are able to kind of move through this and create their business plan to take into account these ordinances, there's a lot of demand. And here's some stories about that demand. So these are some properties that we recently sold. This one sold earlier this year, and it was on Mercer Island. I bring this one up just because it does really show the amount of interest in property. Mercer Island is a very unique location. There's just not a lot of buildings that come up there, and there was a strong desire from even people that live on Mercer Island to get into the mix. So we actually saw 13 offers on this property, and we ended up listing it just about at a 3 cap, a little bit below. and we ended up selling it at about $400,000 over the list price. And it was an all cash buyer, no contingencies at offer time. Once they had some interior access, and it closed in 51 days. So no financing, all cash. And ultimately the closing cap rate was 2.68. So if we remember the averages that we talked about before, is pretty a big premium put on this building. So this is another one that that is a fun one to talk about because it's in Lower Queen Anne, and just has always been one of my favorites. It's right up from the metropolitan market. It's very close to the Climate Pledge Arena, which is now open finally. And you know, the Lower Queen Anne uptown area, it's had some homelessness issues and some things along those lines, but now kind of getting people and events back in that area, more foot traffic, that's really helping. And this building sold at full price. Interestingly, we put together a seller financing structure on this property. That can be a really interesting method, especially if you're looking at, you're not as interested in doing the active management anymore. You have a ton of equity in your property. You don't really want to just buy something else or go have a bigger asset. And it's if you know the property, you feel comfortable with what that is. And obviously, if you play the bank as a seller, holding a seller note, you know, you still maintain a little bit of a connection to that investment property. So this ends up being a nice structure, and which is why I wanted to include it today, kind of as a benefit to buyer and seller. You know, buyer typically would get a little bit more flexibility. You don't have all the overhead and kind of stress of figuring out what's going to happen with the bank, and you can maybe get interest only financing on the front end if the rents are low, to kind of do some work and get things fixed up. So again, it can be kind of a win-win for both parties, which is always what we're trying to find. And then here are a couple on markets just for fun. This is a building, it's a quarter block in Fremont, which we love, and it's got a lot of potential. It definitely, through the pandemic, you know, the owner was very proactive about adjusting rents so that all of the mixed use, the business tenants could kind of make it through it, and now it's performing really well. So this is a fee simple property in Fremont, which is actually quite rare. And then this one we're actually looking at offers today on, and I think we're getting lots of them. And this is a property just a few blocks from Cary Park here in Queen Anne. So happy to take any questions. I know that I kind of sped through everything. We just have a couple of minutes, but happy to field any questions. Couple of parting thoughts just about maintaining value is really thinking of your business as we're in the customer service business and our tenants are our customers. So, you know, having a good relationship, line of communication, it's a really important part of making sure that the building performs financially. And then I think there's a huge advocacy need now. We've got a lot of headwinds from a legislative standpoint. So get involved with, you know, the Rental Housing Association or other groups to help make sure that we preserve our rights as property owners. And so, and the other piece is, you know, educating your tenants so that they can also understand how all of this works and prioritize their safety and some of the things that are out there. So, any questions at all? I'm looking at a couple coming across here. I've got one question about structured installment sales for tax mitigation. And I kind of mentioned the seller financing, that actually technically is a structured installment sale. There are some commercially offered groups that sponsor and create those investment avenues. But if you think about receiving a down payment, that's like a principal return. So you're paying your capital gains on a down payment, but not on the full price of the property. And then you're just getting ordinary income. And if you do interest only, you're not actually receiving that principal either. So it is also for sellers a tax beneficial structure. Hopefully that gives you a little bit of an information on that. And then the question here, calculating capital gain tax for seller appreciation. I would say, when we start to get into the realm of tax, I always like to align with whether it's the owner's CPA, or if we're working on a 1031 exchange or doing a DST, bringing in those team members is how we look at it, whether it's helping to make sure that we get the 1031 exchange facilitator on board early so they know that we're going to be working on that, whether they're looking at doing a DST or looking for additional property and helping identify property to buy. So that's sort of where we can help. But when it comes to sort of individual tax calculations, it's better done with your CPA. Typically, when we put together a valuation, we include a net kind of estimated net proceeds. That's the page that you take to your CPA to see what your taxable impact would be from a sale. Any other questions I can answer right now? It's been a pleasure. Thank you so much for being here today. Hopefully I answered questions. Always happy to talk with you on the phone, meet over Zoom or Teams, or meet in person, which we can start to do a little bit more now. So please do reach out to me. We have a website that has lots of good information. I'll have this presentation up there later, and it also has a copy of that report that I talk about that we do twice a year. So please reach out if we can be of assistance to you. Thank you very much.